One normal day, you turn on the TV and see the headline, "The stock market just lost $1 trillion in a few hours." Sounds like a movie scene, but it is real. And the big question is, why does this keep happening? Is it bad luck? Is it manipulation? Or is there something built into the system that makes it collapse every now and then, like a house of cards? In this video, you will learn what a stock market crash actually is, why crashes keep coming back, who is usually involved in these crises, how governments and people react when panic starts, and of course, can crashes ever be prevented, or are they inevitable? All explained in simple language, with real examples, and no boring financial jargon. Section 1. What is a stock market crash? A crash happens when stock prices collapse in a very short time. It is like walking into the grocery store and discovering that rice went from $20 to $2. At first, you cheer, but then you wonder, wait, what is wrong with this rice? The most famous example was in 1929, when Wall Street collapsed and triggered the Great Depression. It was as if the entire world suddenly woke up inside an economic nightmare. Section 2. Why do crashes happen? Because markets are made of people, and people overreact. Speculation. Buying not because you believe in a company, but because you think someone else will pay more later. That is exactly what happened during the dot-com bubble in the 1990s. Leverage, using too much borrowed money. Small drops turn into big disasters. External shocks. Wars, pandemics, energy crises. In 2020, the pandemic sent markets down almost 30% in just 1 month. In short, too much euphoria always ends in too much fear. Section 3. Who is to blame? There is never just one villain. In 2008, American banks gave out risky loans, packaged them as safe investments, and sold them worldwide. When homeowners could not pay, everything collapsed. Back in 17th century Holland, during the Tulip Mania, a single tulip bulb could cost more than a house. When people realized they were just flowers, the market crashed overnight. The truth is, crashes are always a mix of greed, naivety, and fragile systems. Section 4. How do people react? Panic spreads instantly. Investors rush to sell, governments launch rescue packages, and newspapers scream about the end of the world. But some people do the opposite. Warren Buffett, one of the greatest investors of all time, famously said, "Be fearful when others are greedy, and greedy when others are fearful," which means, while some lose fortunes, others build empires. Section 5. Can crashes be prevented? The short answer, not entirely. We can make rules, like those introduced after 1929 and 2008, but we cannot erase human greed and fear. The only realistic strategy is to prepare, manage risks, and remember that, throughout history, markets always recover. Conclusion. Markets crash because we are human, emotional, greedy, and sometimes irrational. Crashes destroy wealth, but they also reset the system and create new opportunities. The key lesson? Crashes are not the end of the world. They are part of the world. Now I want to hear from you. What do you think is the craziest bubble in history? Tulips? The internet? Cryptocurrencies? Drop your thoughts in the comments. If you enjoyed this video, make sure to hit the like button and subscribe for more simple explanations about the financial world. And if you want to keep learning, check out our next video, How Money is Really Created. Trust me, it will surprise you.